Hi, folks. Dan Bird here. Wednesday, the 13th of March. I'm going to do a quick midweek update, talk about what's happened so far this week. Let me share my screen real quick. And if anyone's interested, my website is right here. This is the main page. If you want the free newsletter, just click this box. If you want to register your email so that you're notified that the newsletter is available, then just sign up on the $0 newsletter notification down here, and you'll be notified. And then there is a subscription for all the rest of the stuff that I'm going to actually be using today. But that's how to get the newsletter, breakpointtrading.net. First, let's talk about where the market is. So S&P, again, continuing to go higher, but we still have the negative divergence. So nothing has changed. It's still staying in this channel. It hasn't gone below the 21-day moving average. So that's really what we're looking for. So the S&P is continuing higher. Now, that in the face of a higher CPI report. So let's take a look at the CPI. It's under the economic charts over here. See CPI headline. And you can see this is the one that dropped off this month. It's fairly large one. Usually when a large one drops off, it helps CPI, meaning it brings it down on this end. However, it actually went up this time. So it was up from 3.1. The forecast was 3.1. I mentioned last week on Sunday that 3.1 was reasonable, and it might very well come in higher than that. And the reason that I said that is because of, again, in the economic chart section under Fed rate hikes. These are all of the rate hikes that the Fed has done so far. We're going to have another one here next week, I believe. But you can see this shaded area is the area that the CPI was reflecting. And agriculture, which is food, went dramatically higher. CRB, which is these four components over here, a big part of that's agriculture, went much higher. And gasoline and oil all went higher as well. So because the commodities were much higher, even with that big one dropping off from last year, from 12 months ago, this basically trumped it. So this took a little higher precedent and caused CPI to go up. Now, what's going to happen next month? So keep this view in mind. Right now, the commodities down here are continuing to go higher. We're about halfway through the month, and they're actually still going higher halfway through. So if that continues into the rest of this month, and we look at CPI right here, that a much smaller one will drop off here next month. That will not help CPI. So that's for the April report. So that combined with the commodities may send CPI even higher than 3.2. That could be a big problem for the Fed. We'll see. Now there's a big one that drops off the month after. So that the next month after that, which would be May, actually might look pretty good. But then the next two after that are small ones. So they might look pretty bad. So going into the summer, there could be some choppiness as a result. Keep that in mind. We'll talk about this again when we get close to CPI. But so what's happening? So CPI was hotter than expected. So why does the market keep going higher? The market just wants to continue to go up. Here's what the S&P looks like. And it just is relentlessly going higher. What I think is happening, as I've always said, the market is 6 to 9 months ahead of the economy. I think all of this trend right here is pricing in future rate cuts. So if the Fed cuts in June or July, then this is pricing that rate cut in ahead of time. Always remember that the market is 6 to 9 months ahead of the economy. So if we look at the NASDAQ, 1 year. That one's going higher. Let's look at the same kind of chart. NASDAQ continues to go higher. So I think it's pricing in the rate cut. So what does that mean? When we actually get a rate cut, does that mean the market already has priced it in and will then start to fall? It could very well. That very well could be the case. It also puts us right into the middle of the summer, which is typically not a great time. And for the presidential cycle, as I've showed before, the September to the election, basically November time period, we usually have a pullback. So we could very well see the market just chug on higher, and then we get a rate cut and everything falls apart. We'll see. There's no guarantees, naturally. So wanted to show CPI. That was an important part of what happened this week. PPI is tomorrow. So PPI has been steadily coming down. It went up a little bit last month, and I think this month is probably going to go up a little bit again. But interestingly, the rate of change for PPI is below 0. So that is deflationary. That means the PPI, producer price index, is actually going down. It's an inflationary period. Even the 3-month rate of change is below 0. That actually is a good thing for the economy because it's going to make things cheaper in the future. Which brings me to my next chart, which I just added. And the reason I added this is because it's called the 33-year cumulative inflation. This is under the economic charts section. And this is because a lot of the politicians out there are talking about, hey, inflation is coming down. Well, if you've been listening to me on this channel, you know that that's not the case. Inflation is not coming down. The rate of change of inflation is coming down, but inflation itself is continuing higher. So if we look down here, we've got CPI, core CPI, and PCE. These are all the rate of change, the 12-month rate of change. So that's what those main numbers talk about when they say, you know, inflation is at 3.2%. That's a 3.2% change over last year, but the prices are continuing to go higher. So I created this chart that goes back 33 years to show what the cumulative CPI is, and this is real inflation right here. So that's the cumulative effect of that CPI rate of change. And I marked it right here in 2021, which was the year, beginning of the year right after the pandemic. It's a 31-year period, and it went up basically 108% in 31 years. That equates to a 3.5% per year rate of change on average. Now, sure, some years were lower. You can see here in 2009, we were actually in a deflationary period for CPI, deflation down here for PCE, and also deflation during the pandemic for PCE. But in general, on average, over that 31-year period, inflation went up 3.5%. So what's happened in the last 3 years, since 2021 until now? Well, first of all, you can see the slope has increased dramatically. It went back up to the top of this channel and did not come down. It continued going higher. Yes, the slope is not as steep, but inflation is still going higher. And if you look at this over a 3-year period, that's 18% that it's gone up, 17.9, or let's say 18% that it's gone up. That's a 6% per year on average increase versus a 3.5% per year is what the standard has been over 31 years. So whenever you hear inflation is coming down, don't believe it. Inflation doesn't come down. It hardly ever comes down. The only time it did was right back here in 2009 when we had deflation. But inflation continues to go higher. It's just what is the rate of change each year of that inflation. So keep that in mind. Also on the jobs number, I made a change to my chart here on unemployment. We talked about this on Sunday, but what I did was I changed the moving averages to reflect the SOM rule. So the SOM rule says recessions start when the 3-month moving average, which is the red line, rises more than a half a point, 0.5, half a point above the 12-month moving average, which is the green line. So, and I actually calculated that. So right now it is above the green line, just like it has been before these recessions. So the next piece is a half a point above the moving average, the 12-month moving average. And the 12-month moving average is right over here, 3.68%. If you add a half a percent to that, you get 4.18. Almost exactly what Zuber had said, which was 4.2. That's the level where we need to really start getting concerned, because from there, it could accelerate dramatically after that. And that's the point where I think the Fed is going to start cutting. So watch this each month as we get the unemployment rate. Right now, since I've changed this chart, it actually reflects a more accurate picture. And I've actually put in the numbers right here. So this will change as the average changes, but it probably will go up, if anything, because the averages are going up as well. So keep that in mind. Finally, I am going to show you, because today is the 1-year anniversary of this market timing strategy that's on the website. Exactly 1 year ago, gave the buy signal on March 13th. Long-term buy was right here, March 13th, when this changed from red to green. This is one symbol, one trade over a whole year. So today is the 1-year anniversary of this signal. And right now it's up 111% over a 1-year period. Not bad. So when will this change? Well, this will show you. So you don't have to think about it much. Just look at this little chart. And right now it has a neutral early signal. Then we want to watch the short term, see when that turns bearish, midterm when that turns bearish. The way that I am going to do this is I am not going to work just on this signal right here, but I am also going to incorporate the VectorVest signals as well. So as soon as VectorVest gives a confirmed down signal, then that's when I will give the sell signal on right there on the website, and you'll see it right away as soon as that happens. So VectorVest right now looks really good, actually. It's still on a confirmed up. We look at the graphs, market timing graph. And by the way, VectorVest has a system very similar to the one that I've just outlined, using a single ticker, and they use the confirmed down signal as their exit point as well. So that's what I will use. So if we look at the, let me see here. Right here, you can see we are still in a confirmed up. There's the confirmed up signal. We won't get a confirmed down until, this drops still a little bit more. These have to be red, basically. They've got to turn red, and it might take another 2 weeks for that to happen. But as soon as we get a confirmed down signal right here, that will change this view. And this, instead of this saying long in the market timing strategy, this will say cash. So that will be the signal to go to cash. There'll be a vertical line right here on the chart, blue vertical line of go to cash. And then we're going to wait and see if that down signal persists. And if it does, then we will consider going into the negative or the inverse ETF and actually make money on the downside. Probably won't be 111%, but we could still make money even if the market's going down. So anyway, I just wanted to bring that up because today is the 1-year anniversary and it's done really well over the last year. Just wanted to give you a sense for when that sell signal will appear. And it will be primarily will be VectorVest unless this one crosses sooner than that. But I think the VectorVest signal will probably happen first before these cross. So you'll actually get out a little bit earlier by using that signal. Anyway, that's where we are today. Hope everyone's doing well. Have a great week. And if you're interested in the newsletter, just go to breakpointtrading.net, click on right here for the free newsletter, and wish everyone the best. By the way, I will not be talking to Zuber on Sunday because we are going to Cabo for the week. So we're going on vacation. There won't be a call with Zuber. That's one of the reasons I wanted to do this one today. I think we are still heading higher, but the market is, still has that negative divergence. So it could turn around at any time. So just be cautious. Anyway, hope everyone has a great week, great next week, and I will be back on the 31st for another session. Thank you very much and take care.